Welcome back to DeFi Unlocked, each week bringing you an episode with in-depth conversations with leading minds across DeFi. I'm Sydney, and today we have the privilege of speaking with Julian, CEO of InvestorX. Julian's well known for his thought leadership in the space of tokenization of assets, liquid assets. His work in the field with InvestorX is paving the way for the tokenization of assets and liquid assets across institutions and the wider investor base, more so than ever before in traditional markets. So in this episode, we're going to delve into Julian's insights on this particular field, and the audience will walk away with what it is, who it's for, how it's achieved, and why it should be considered. So, Julian, thank you for joining me today.
Yeah, thanks a lot for having us. Appreciate it.
No problem. So, just to get started, give people a bit of a base. Tell us a bit about your history, how you came to found InvestorX.
Sure. Yeah, I've been running my own startups since I left university. So I spent 13 years in China, did a social media play, real estate, first carbon neutral hotel, development, raised a bunch of real estate funds, and then wanted to get into kind of the intersection of internet and fundraising and finance. So moved to Singapore about 9 years ago and started InvestorX, which its first generation was called Investor Crowd, and it was one of the first real estate crowdfunding platforms. So then what we did was launch that, and we're part of that first kind of generation of P2P and equity crowdfunding. But then I realized that actually was quite low tech. And once the 2017, 18 ICO boom to me was sort of crowdfunding 2.0, and tokenization and smart contracts was the tech that we needed for online investment platforms, real world asset or not. That just came a couple of years after I started. So we went then full tilt into tokenization and started building all the infrastructure to make a complete end-to-end issuance, including IXSwap, which is the first automated market maker for security tokens. So it allows anyone with an STO to start a liquidity pool. And so, yeah, we've just been hard at it with my partners and the team, believing that this is kind of the biggest opportunity in finance, in parallel to cryptocurrency, but related to tokenization real world assets. People probably don't really know that the private markets and real estate and private equity, everything that's not publicly listed, is 7 or 8, 9 times bigger than the public markets. So the opportunity is multiple times bigger. And, again, for all of those private assets that aren't in digital or tokenized form, is it just the biggest asset class out there that is illiquid and not transparent and all those kinds of things. So that's how we got here, and we continue to be kind of excited by, especially what's happening this year related to tokenization and everyone jumping on the bandwagon and getting involved now.
So I did a bit of, obviously, preliminary research into the company and sort of understanding just from your website and a few other, speaking to a few people, what it's about. And you've got on there the tokenization of a liquid asset. So let's first cover, just for those who aren't necessarily privy to that asset class, what would you consider the leading liquid assets that you deal with? And I guess, what does it mean? Just a basic definition. What does it mean to tokenize these assets? Let's start with that as a base.
So the 101 of tokenization is really, what are the benefits of digital versus paper? So what's a digital share? We've got, the elements of transparency, improvement of transparency, enhanced liquidity. But actually, what we believe fundamentally is that all companies and special purpose vehicles and assets, debt and equity and real estate and private equity will all be tokenized. Why? Okay. Because in a digital format, so let's go back to where companies are typically registered. They're typically registered at a government entity, right? Singapore has ACRA, whatever. Cayman funds are registered in the Cayman. Now, in any particular company that's issued on paper, which is most companies in the history of the world, no one actually knows truly that second who really owns the company, because there might be shares being sold, there might be directorships being transferred, and as you know, these things can take weeks, if not months. So a distributed ledger technology and tokenized shareholdings of companies is preferred and will be desired by most governments, because they can open a laptop and they can see instantly who owns what. So tokenization of real world assets is actually is something that is positive towards transparency, and therefore is positive towards regulation, right?
That makes sense.
So 101 of tokenization was just let's get all these paper shares, and if anyone is invested in a fund or a private company, that usually goes for a very long time, and a lot of people actually lose these agreements or can't even remember exactly what's going on. I think the digitization of that is beneficial. For us, we look way beyond that, and we think, well, if you actually think about the history of the public markets, every significant expansion to capital was new technology marrying the marketplace. So what are the two best examples? Electronic trading versus chalkboards in the New York Stock Exchange, dramatic effect on the market. And then from a structure or an offering perspective, think about the ETF structure, which in 1989, I think, was issued as the first time. It was considered a failure. It raised $7 or $8 million. But it now is a $6-7 trillion asset class because it's this new technological structure that could be then built on. So how we think about tokenization is it's a given that everything will be digitized and tokenized. That's the 101. What's really more exciting is, first of all, we're developing new investment products. So a better real estate fund, a better VC fund, we call VC Fund 2.0, like Real Estate Fund 2.0. Digital tradable. That's much more attractive for investors. I mean, the average hold period for a VC fund is like 15 years. Most people don't really know that, or most people aren't told that, because who wants to invest for 15 years? And the answer is not really that many people.
Gotcha.
But there's all these new products, and then plugging into DeFi.
Yep.
So automated market makers, the power and innovation of DeFi. If you could take your asset-backed tokens and plug them in and create lending and borrowing and staking on your VC fund shares, that's like a whole new...
So there's like an interoperability between the tokens you get from like a secondary market in private markets and what you can do with those assets with the underlying value in DeFi, right?
Yep. And with a world of digital currencies, you want a world of digital securities, right?
Of course.
And then interacting is going to be really exciting.
So you mentioned something there, like upon the advent of online, electrical trading, and then obviously you can even go further into online trading, where it opened it up to the retail market, accessible in everybody's home to trade equities quite quickly. So what you're saying is you see parallels between those innovations and opening up that same innovation to these private liquid assets as well, right?
Yeah, I think, you want to be able to, today you can open up a crypto, your app on your phone and a crypto exchange and buy and sell whatever. You can do the same on interactive brokers with 1 million stocks. Like, why would you not want to take all your private market assets and do the same thing?
It makes sense.
Yeah.
So let's you touched on a few, but maybe we can get a bit more specific about your leading liquid assets that you're dealing with right now.
Yeah. So obviously one of the big ones is real estate. What we think when we think about tokenization, we think about any asset that has more than one investor.
Yep.
Because when there's more than one investor, there's always a special purpose vehicle set up or an investment holding company. So whether the building is on or off blockchain doesn't matter, or the private equity asset, the energy product, whatever they are. It's about the shares of the holding company. So when we looked at that, we expanded way past real estate, and we thought, well, what is also private market liquid assets, VC funds, private equity funds, and the list goes
so you're
on.
saying it doesn't matter if the asset's on chain, as long as the shares are able to be digitized.
And often the assets are not on. Typically, the assets are not on chain at all, right? But that doesn't matter, because you're tokenizing the shareholdings of. So so that's how we kind of envisage.
So you
it.
identify which assets to go for. Because there's an opportunity there.
Yeah. So then ultimately, when Cayman and BVI and Singapore and the VCC and everything gets tokenized, then all assets in brackets will be tokenized, but they don't have to actually. The assets themselves don't have to
be on chain.
Don't have to be on chain. And a lot of them will never be on chain.
Got you. So you started with real estate and the other ones you were going into?
Yeah, real estate. So we've got some carbon credits. We've got some ESG related thematic funds. We're moving into startups. So we think tokenized early stage startups.
That'll be interesting.
Super interesting.
Yeah.
And I think we can get some real excitement. Like the ICO got the excitement. But
secondary markets are really illiquid like right now, and I don't think anyone's mastered that yet in general.
No. So. And people, I think, are also... There's a lot of people with misconceptions. Tokenizing an asset doesn't necessarily mean anything. I mean, it doesn't guarantee anything, right? It depends on the quality of the asset, where it performs, where it trades, how many eyeballs, what's for sale, who's buying. But it's certainly in a digitized format. It's got a lot of enhancements. So you can move it around a lot faster. You can be able to do a lot more things with it. That's how we kind of see it. And you're starting to see all different types of assets in brackets being tokenized, but really you're seeing all types of ownership structures that own different assets being tokenized.
Got you. We'll go into the specific benefits in a sec. So you got real estate, private companies. I saw private debt on there as well, and funds. Can you talk us through that too?
Yeah, so the fund space is very diverse. You have a whole bunch of funds targeting energy, ESG kind of thematics, carbon related. We're asset agnostic, so we're happy. We're building the infrastructure that allows anyone who's issuing an asset to tokenize it, and then all these investors to buy it. So with that, in that bucket, you're also seeing venture funds, you're seeing startups of all different shapes and sizes. Startups are a tricky one because once you get past the early stage rounds, as you would know, there's series A, B, C, D. There's all these different share classes. There's these side letters.
People want to exit earlier.
There's all kinds of stuff.
Yep.
So again, it's still possible. It depends on how you structure it. So is it a new share class that is, whatever, that can do ABC and can't do XYZ, but that's the form. So it's really up to, we're asset agnostic, and we're looking to try to help as many companies tokenize as possible. And in the history of this tokenization, which is very short, a couple of years, right now you've got like the JP Morgans, the BlackRocks, the Credit Suisses of this world who built their own engines because they're big enough and they can. But for 99.9% of investment firms, where do you go? How do you start?
Well, that's a point we're going to get into, which is like, okay, now we're seeing an opportunity open up to these investment firms that previously was beyond reach.
Yes.
Access to these private markets, and therefore offering this new return, this new asset class and level of return or yield generation to their end clients as well, that previously was only exclusive to like a very large traditional financial institution.
Yeah, I think that that's certainly one of the benefits.
Yeah.
And I think that what's really exciting for the market is that typically these private market assets, real estate deal, your real estate deal, my VC deal, it typically doesn't get distributed in, call it B2B distribution channels. What's a B2B distribution channel? A private bank, a wealth manager, a money manager. Why? Because typically they only trade publicly listed assets. Why? Because they're liquid and they're transparent and they're digital and they're tradable. And so tokenization essentially is bringing the characteristics of the public market assets and marrying them with the returns of the private market assets.
Yep.
And for all those guys in that space, it's a race to zero on fees, right? And because we're in DeFi, and I'm sure we love blockchain and crypto, most of that entire audience, which is huge, they fought Bitcoin forever and then realized they could make some money on it, and there were some fees there, so they started selling it.
Got you.
And then they started selling the altcoins. And what's interesting about a private market asset versus, say, selling a public REIT to your customer versus the fees that you can make is many multiples bigger.
So you're saying that's an added benefit on the B2B distribution front?
Massively. You can then get your VC fund or your real estate fund into this private bank, which was literally impossible before.
Correct. And I guess the fees won't be exorbitant as well because it is on that DeFi infrastructure.
They will compress down.
Yeah.
I'm sure those guys will hold up at the start. But they're willing to distribute is the most important message. They're willing to distribute. Yeah. So that's a whole new world of assets for them.
Of course.
A whole new world of investor channels for issuers, and a system where they can get paid because they can see it all and it's on chain. They can clip a
ticket on the way.
They can clip a ticket, and it actually should be a lot easier than crypto to understand because it's real world assets.
Well, that's the thing. Like for the first time ever, it's not tied to speculation and hype. It's tied to real world data.
That's right.
But that's really interesting. So obviously, just to summarize that, the marriage again of the disintermediation aspect, well, you don't need necessarily the traditional banks. It's coming down the chain, downstream to a lower level of B2B distribution. They have an ability to not only make money on management fees, but also a new asset class to invest in as well for their clients, which makes them competitive to the rest of the market too.
Yes.
Do you see this taking share? I mean, I'm sure you have a more nuanced, to the naked eye, it would seem like you're taking shares away from the larger traditional financial institutions, that market share, or is it a bit more nuanced than that?
No, I think it's completely the opposite. I think you're giving them new revenue streams. I think you're giving them new products to sell that have today a lot of margins that'll compress over time, like public market assets. But you're literally adding business. And one of the misconceptions of these groups was, well, I don't want to sell that. I don't want to sell this guy's VC fund. Why? Oh, because I'll lose some AUM. I was like, how are you losing AUM? You don't sell it now. You could add AUM. And typically your clients, again, you don't sell that product. So how could you be losing? I think it would add. Now, that process, that mindset is changing. But I think what's exciting is it's really more. It's not less from one side. It's more for both sides. Yeah. So I think that's why it's a bit of a win-win, I think. But it takes time for these people to get on board, but I think it's all coming together.
Okay. So let's dive into, we're going to get a bit technical now, and like, as technical as I can get because I don't have a technical background, but let's discuss how blockchain technology adds this new dimension because, we've covered tokenization, we've covered elements of DLT and how that, allows some sort of efficiencies, but what's the specific benefits that blockchain brings to, DeFi brings to tokenization?
Yeah, well, so what I'll give you...
And can I just add something to that?
Sure.
The reason I ask that is because it has existed before, but hasn't necessarily been picked up, right?
Yep.
Is this going to bring more adoption to tokenization of assets?
So I'll give two specific examples because that's a great question. And I think there's a lot of people who are like, why do we need to tokenize? Yeah. It's like, well, why do you need to use email? Why don't you write a piece of paper and mail it to everyone? You don't have to use email. It's just obviously a lot more efficient. But moving past that sort of 101.
Yeah.
So let's think about a fixed life private equity real estate fund. So for most people that don't understand that, if you invest in a private real estate deal, it's typically 7 years. Right? Why? Because no one will give you money forever. 7 years has been 7 to 10 years has been an industry standard that's built because Sydney needs to raise money. He needs to buy a building site. There's lots of different assets. I'm just giving one example. He needs to build the building. He needs to sell it. Well, that's going to take some time, right? To create value with the money used. But let's take a specific time, 2 times, 2003, 4, 5 US commercial real estate funds, 2012, 13, 14 US commercial real estate funds were forced to sell at the end of 7 years. That first period of time was the GFC when everything was completely underwater. The second time was COVID, right? So those 2 specific examples meant that at the end of 7 years, the fund manager has to sell, everyone loses money, and the fund manager typically claims that the 2% management fee each year is to run the fund. They don't make money. Their take is the 20% upside when the fund sells in 7 years. When the fund loses a lot of money, there's no upside. So what an enormous waste of time and capital for those 2. That's one of the biggest asset classes in America. So you're talking about 4 to 6 years of real estate funds getting washed. In a tokenized format that we've come up with, you could have a digitized fund. The fund manager, it's like an evergreen vehicle. The fund manager can raise it and then go build and continue to invest. He doesn't have to close the whole thing down in 7 years. If you get to a 7-year period and there's a GFC or a COVID, he doesn't have to sell. He can ride it through. Now, investors can now invest in this fund like they would have anyway. He's still saying he wants the money for a period of time. And if I, as an investor, want to either take dividends along the way, I could just sell a couple % of my shares in the fund each year as tokens, or I could just hold on. Or I could invest more when he goes. So that's just one example of what a tokenized real estate fund, the flexibility and the kind of robustness and the optionality that you could get if you issued a tokenized format, right?
Gotcha.
So that's just one specific example. We're looking at that from an ESOP perspective, from a venture capital perspective, even from a startup perspective. Like, don't just think, what's the tokenized version of this exact same thing that's being done one way? Why do we do it that way? Because that's how the industry does it. Is anyone even ask, is that the best way to do it? Or is that just how we've ended up 50 years into this doing things, which is often the case? It's nowhere near optimal. Sure. So that's one example. And then talking about the DeFi. So, back in 2017, 18, there was a big problem in crypto. If you were a top, I'll make it an extreme example. If you're a top 10 cryptocurrency, you listed on Coinbase and Binance, things were great. You had millions of dollars, you had market making fees, it was rosy. If you're one of the 10,000 altcoins that weren't in the top 10, you sat on a DEX, decentralized exchange with no liquidity, and that was the game, right? And it was pretty lifeless on the decentralized exchanges, because that decentralized exchange is a swap model. It's not a traditional exchange. It doesn't have order book and matching engines, until Uniswap came along and put a big dent in the universe. And they said, well, we got an idea. Why don't we build these DEXs and make it so anyone with 2 cryptos can create a liquidity pool. And now we're going to actually have crowdsourced market making. What we're going to do then is we're going to allow people to come and buy and sell on the DEX, but there's actually going to be some liquidity. And if you join the liquidity pool by putting in your tokens, percentage of the fees, boom, 0 to hero, right? Why am I giving this example? So what's the connection of tokenization to DeFi? For us, when we think about jumping back to tokenizing real world assets, most people think that and I see most people, I'm talking about real estate groups, private equity, I've spoken to thousands, I'll continue to speak to all these people. They think that their asset's amazing and it belongs in a centralized exchange with an amazing market maker to make the market who they've never met before, who has no idea what their asset is. Well, that's not true, unfortunately, for most people. I think the world of tokenized assets, so the problem that you have in DeFi in 2017 for altcoins will be many times magnified in security tokens, in real world asset tokens. Why? Because 99% or more of real world asset tokens don't belong in an exchange. They're too small, they're too obscure, there's no price discovery, it's your real estate, it's my VC, it's his startup, and it's 100,000 other guys doing the same thing, and girls. But they'll all want some tradability. So what you're going to see as we move forward is, thousands and then hundreds of thousands and then millions of security tokens all wanting some form of trading, but they don't belong in an exchange because no market maker can actually facilitate that anyway. There's too many different assets, but they're all just different types. So they'll sit on listing boards of security token issuance platforms, which is kind of like the altcoins of 2017. So what we've done with IXSwap, which is our other brand, is we built the first market maker for security tokens, and it allows anyone with an asset-backed token to turn up, if it's onboarded, bring the other pair, whether it's crypto or stablecoin, which makes a lot of sense for real world assets, and create the first liquidity pool, as long as it's $10,000 in value. So we've created a system that allows anyone with an asset-backed token to start a liquidity pool, which has been the biggest pain point, question mark, et cetera, for the asset-backed space. Where's liquidity? Where's liquidity? And now we say, well, you're the liquidity. And they say, what do you mean? I'm like, you can start a liquidity pool. They're like, how the hell does that work? And we're like, this is how it works. So the power of DeFi with tokenizing real assets is I can take a $10,000 share in my startup and I can create a liquidity pool and people could actually buy it. That's like a 0 to 2 value proposition. And that's what tokenization does, far beyond digitizing a share. So there's a lot going on.
That's actually a unique answer, because that's when you think of the generic, there's so many generic answers out there. Right? It's decentralized, it's transparent, it's immutable, all that stuff. That's a bit, but you've taken it to another dimension there. It's like, actually, there's going to be a scenario where the market's not going to magically appear for these assets. We're talking about a brand new asset class with a whole new, people have to understand startups individually. People have to understand all their funds in. But if you start with your own market using an AMM, an automated market maker, it kind of solves that issue, and DeFi gives you that ability. Yeah,
and it's magic. I think IXSwap's the killer app for the space. It differs, though, for those that know the tech side. And Uniswap is creates the liquidity pools and the trading just with smart contracts because it's crypto.
Sure.
And it's decentralized. There's no one there. Because we're talking about asset-backed tokens, to do the same thing legally, behind IXSwap is a security token broker-dealer and a security token custodian. So you have licensed securities companies that are integrated with the tech, facilitating the same thing that you look and feel with a swap and a pool, but it's doing it legally. So security tokens, asset-backed tokens are not allowed to be traded on Uniswap because they don't have any securities licenses. Is
there still a framework of price and underlying valuation that maintains the value of these assets? Because this might sound like a stupid question, but if you're now tokenizing your securities or real-world assets, how are you maintaining the value off-chain, on-chain?
Yeah, so it's work in progress, and it depends, what are those assets and how they're doing it. People, we built the first AMM. Price discovery, if you will, is a big thing. There are people attacking this problem with oracles and whatnot. There is the on-chain, off-chain component to this as well, depending on the assets. But I think the simplest way to think about it now is like, well, how is an asset valued? How is that asset valued
in the real world?
Typically, I don't know, once a month, once a quarter, once a year. Okay, well, that's how it will be valued now.
And
at least
can you
by
lock
the
in
source.
those prices when you're distributing it?
If you, from a trading perspective, you could. Well, you can't lock it in. You can put your price there, and if it turns up and hits. What we've done is now facilitated the ability for anyone with an asset-backed token to start a liquidity pool, and then it's market forces.
Gotcha.
Right?
So it's up to market.
We have built, again, just to get a bit more technical, we have built a mitigation function into the platform where if you, as the person who set up the pool, and this is basically based off MEV attacks and attacks on these prices that you'd see in other DeFi, you can set it 5%. So any trades above or below 5% outside
Of a range.
your price won't go through.
Oh, that's good.
Yeah.
That would make more sense.
It makes more
because,
sense for asset-backed tokens. For crypto, I don't think anyone would ever use
No,
that.
because they'll destroy the purpose. But that's how it works. So like you can't go for the full decentralization. There's got to be some compromise with some centralized and some traditional forces, right?
Yeah,
because you don't want somebody just smashing the value
That's
of
right.
your real
That's
asset
right.
straight away.
Yeah.
So that's cool. So there's a mitigation component to
Yes.
your platform. That's a lot more. That makes it a lot more attractive as well for those getting into the space. So let's talk about towards the end of this. I want to talk about what does an institution need to do to gear up to participate in this? Let's assume that let's assume two personas. One's always been in traditional finance. One's been in digital assets, but just been doing token allocations this whole time. Now there's this whole new class. Yeah.
So I think one of the pushbacks from, call it the crypto community on security tokens, asset-backed tokens over the last couple of years was really more around what's needed to get involved.
Sure.
KYC, AML, basic stuff. Now I think we'd all agree that it's all crypto. Regulation has come for crypto, and basic KYC and AML, outside of maybe DEXs, is just the norm. But you talked about institutions, right? So they're not going to just trade willy-nilly on sort of DEXs with a bunch of unknown participants. So for us, it's quite simple. Like security tokens don't need new rules and regulations. We have securities regulations. They don't even reference paper. So there's been some wild misconceptions that we need new laws and new everything and to get things started. I would say that we probably need some updates and some upgrades to some of those laws because we have this new technology coming. But we're in a world where, you can go buy security tokens on platforms like InvestorX, IXSwap. It's no different from an onboarding perspective or journey that an institution would have anywhere now, right? KYC ML, in Singapore, we're licensed by the MAS. So the difference is when you're actually buying and selling and what you're getting a token in a wallet versus a piece of paper that goes in your drawer for 10 years. And there's that element of UX UI that changes. But to get to that point, everything's pretty plain vanilla. How you sell a security token, how you promote or don't promote or advertise it. There's rules for this stuff, and if you don't follow them, you get in trouble. So, from an institutional perspective, it's a better way to buy and sell assets. I think nothing strange about how you'd onboard protections via licenses and regulators, and but then this new world of value that's coming down the pipeline.
So, let's do a bit of like a user journey here. What would an institution today do to start accessing this? Like step by step.
Well, yeah, I mean, you could click on,
like use your platform.
Exactly, yeah. You can go to investorx.io and you could sign up. You can choose corporate or individual account, and then you onboard as to the Singapore regulations for accredited investors, which is pretty plain vanilla for those institutions. Once you're onboarded, you can start to see the assets, and we help get people into their first deal. You put money into your pre-fund your account, which is a HSBC fiat account. So we're bringing in stable coins, but we'll always have the banks for the TradFi old school guys. And then you're buying and selling. And then once you're selling an asset, you're getting dollars back into your account and back you go. So
so it's come a long way from a tech perspective from your initial business there of real estate crowdfunding.
I think the original concept of just crypto to buy security tokens will be the end game. Yeah. But we probably started there a little bit too soon. Yeah. Debate rages around different stables. So we're going to implement more and more stable coins as we go forward. Yeah. Which again are just payment rails. They're just ways to buy stuff.
To store value, right?
It's not the magic isn't in the stable coins.
No. Just a medium.
Yeah, a medium of exchange. Yeah. Exactly.
Awesome. Well, just to wrap it up, where can people find you? Where can they reach out? I know you got a podcast yourself that you do. Do you want to give it a bit of a plug?
Yeah, just kicked that off, Infinity and Beyond. Just trying to find really interesting people and products in the space, kind of like you guys, and just sharing that stuff with the community, new projects, what's coming down the pipeline. As you know, in the space, along comes ICOs, along come NFTs, along come DAOs. Like, it'd be cool to be in communities where you actually hear about these things early and you can start to get your head around it. InvestorX.io is live, IXSwap.io. I mean, we'll put all the links in the notes. And I'm kind of on Twitter, but I'm kind of too busy running the businesses. But it's better just to get on the platform.
Come on, man. There's no excuse. Look at Elon Musk. What are you talking about? But look, thank you so much. You gave us, both the basics of tokenization of assets, but then a whole new dimension that's genuinely unique. And hopefully we can talk again soon.
Thanks for having me on board. Appreciate it.
Cheers, man. Hope you enjoyed today's episode and you got a full-rounded perspective on the tokenization of the liquid assets and how an institution can participate in this aspect of DeFi. For more insights like this, please hit subscribe on the channel, follow the LinkedIn page and reach out. We'll have all our information up there. We'll also have Julian's information up there if you want to reach out to InvestorX as well. Thank you.